On this episode, we're going to discuss how to finance a short-term rental property. We get this call all the time. Hey, I'm trying to buy this type of property. And this is the general spiel or conversation we go through. And there's a couple ways to financing these projects. Obviously, if you're going to occupy it X amount of days per year, you may be able to qualify for it, for the property or the purchase to be a second home. We don't do it here in this division here. But this is just the podcast part. We finance straight investment deals, what we consider business purpose loans. So anything that's non-owner occupied, strictly for business, is what we talk about mostly on the show. Although we do give you guidance on acquisitions, where sometimes a second home purchase might be more advantageous because you can get up to 90% financing and so forth. And it's a conventional product, meaning you're going to qualify from a DTI, from a debt to income standpoint, full doc type of loan. The loans we talk about mostly on this show are DSCR loans. So that's debt service coverage ratio loans. These loans, no income required. It's based on credit score and it's based on the cash flow of the property and loan to value. That's exactly what these loans are for. So let's dive into the short-term rental properties, right? There's a couple questions we go through, right? What's the annual projected gross rents look like? What are the annual taxes? What's the annual insurance? Is there an HOA? From there, we also usually ask, or I ask, is what would this rent for as a long-term rental? If you weren't going to use this as a short-term rental property, what would this rent for? Sometimes using the long-term rental income, it qualifies, because we're going to do a rental survey, and it's going to say that it's going to be an addendum to the appraisal, and it's going to say X amount of dollars per month is the rental comp. So most DSCR lenders only use the rental survey information. There's a couple lenders that are specifically geared for making short-term rental loans where they'll actually use like an AirDNA algorithm, and they'll use what AirDNA says, something similar to that, right? And in some cases, that's our only option because the long-term rents will just never qualify you. They've come out with some no ratio products as well, where it's just, it's based on the asset's purchase price, right? So today we're in a rising rate environment. They came down a little bit the last 2 weeks, but really, rates have gone up considerably. And I think they will come back down after we work through this recession or whatever this debacle we're going through right now happens, right? So, the first thing I like to do is to size up the deal and say, will it work as a long-term rental? Yes or no? If no, can we do it as a projection base? Of course. Does it make sense? Is it a real rural location? Some of those things play in as a condo. But we do have projection-based DSCR lenders. We also have asset-based loans, which are based, what I call the Flex Bridge Loan Program, which is a 2-year term, and it just lends you up to 75% of the purchase price. 2-year term interest-only payments. Rates and terms are based on credit score and loan to value. So those are an option. There's no DSCR requirement for this loan. So a lot of times, Airbnbers are going to buy, they're going to get 12 months of operating history and then refinance once they have proof of income, right? They're going to use their Verba or their Airbnb receipts. They can go into a DSCR takeout or potentially go to a conventional loan. So that's really the fundamentals of how to finance a short-term rental. If you're going to occupy it X amount of days and you can qualify from conventional standpoint and you want to go full doc, second home is a possibility. If not, we can do a long-term DSCR loan using long-term income, if that works. If it doesn't, projection-based DSCR loan. If you don't want to get trapped into a 3 or 5 year prepayment penalty, people are opting in right now with this rate environment to do a 2-year stabilized bridge loan, where that product is for rent-ready properties with no debt service coverage ratio, qualifying principles, really based on the equity. And then there's others that are using fix and flip loan. They buy under market, fix the property, furnish the property, get 12 months of operating history, and refi using a fix and flip, and they're burning out of it. So we have a lot of options. I just want to kind of open up your mind of what we're doing and what we're seeing. And essentially, if you're interested in learning more about what makes most sense for the deal you're looking at right now, you can book a call below, or you can go to bookwithbeau.com and we can talk about all these different loan programs. Thanks again for watching, and we'll see you on the next episode.
Hi, this is Beau Eckstein, host of the Investor Financing Podcast. Are you a real estate investor with properties and you're trying to figure out how to refinance or grow your existing real estate business? Need some clarity and a game plan for moving forward? I'm offering a free strategy call where we dive deep on your real estate investing goals. I'll help you come up with a strategic finance plan that will help you get to where you want to go. Whether you've got a portfolio of 30 properties or you're starting out with your first property, I have a framework that has helped many investors grow. If you're interested, book a call below in the Calendly link.